Fan.
Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
All righty, good morning and welcome to the Smart Investing Show. I'm Chase Wilsey here as your host for the next hour to get you through that hour of investing, financial news, and always important to talk about what you want to talk about to give you that no strings attached fundamental opinion, again, about what you want to discuss. You want to call in later in the show. Phone number here is 833-288-0973. Again, that's 833-288-0973. But first, I want to talk a little bit about what's been going on this past week. Very interesting week in the market, as always. You know, things all over the place. Oh my gosh, COVID concerns resurfacing. What's going on? Stock market's up, stock market's down. Things moving quite a bit. But first, I want to discuss the bond market. I got to say here, I really think the bond market is way too focused on this Omicron variant. I mean, we saw the 10-year note. It slid under 1.4% yesterday and closed the day about 1.4% on the dot. And I just got to believe that the market is missing the boat on inflation, and especially with the Fed reducing its bond buying to just $60 billion per month in January from $120 billion per month in November. And they said, too, likely raising rates 3 times. I would not be surprised to see interest rates climb quite quickly in 2022. And again, I want to bring up, I believe the bond market is just looking way too much at this COVID concern. And, you know, here in California, we have the mask mandates kind of getting re-implemented. We've seen in other states as well. And, you know, kind of seeing other employers pulling back on going back to the office. But I do think 2022, I would not be surprised to see that 10-year note spike back to 1.75, 2% even, and it can move very, very quickly. And especially with the Fed starting to ease on its monetary policy and actually not buying bonds any longer. And they did say that they believe that bond buying should be done around the March timeframe. And the reason that's so important is right now that's a big buyer in that market. So what happens is as the Fed is buying those bonds, well, it's creating demand, which keeps that interest rate low. You pull out that $120 billion, now you reduce that demand. And as it's important to point out, as bond prices go up, that's because interest rates are falling. But if interest rates rise, that creates bond prices to go down. So I'd be very, very cautious on the bond market. I would not be surprised, as I said, to see that around 2% next year as the Fed gets a little bit more stringent on that monetary policy. Now, how does that impact the stock market? You know, I think you got to be very careful of those growth names. And we've been saying that for some time now, but you've seen interest rates not really move that much. I think you saw at the beginning of this year, when interest rates spiked quite quickly, you saw those growth names. And I'm talking about the Microsofts, you know, the Amazons, your Teslas. I think they can struggle immensely when that interest rate does spike. And as I said, I would not be surprised to see it move quickly in 2022. So I would say really focus on the value names that can benefit from it. And you hear people talking about, oh, well, the Fed's doing this, the Fed's doing that. The stock market's going to crash. It's going to go down, 20, 30%. I'm going to sit in cash. I think that is the wrong thing to do here. And one of the big reasons I do not see a crash in the stock market and believe the right stocks can do well in 2022 is the amount of cash that is still floating around in the economy. Last week, $43 billion was added by investors into money market funds, and the total in cash equivalents for assets under management, well, it's to near a record and totaled $4.7 trillion. With all the cash out there, as I said, inflation likely continuing, there's still no great alternatives to investing in good quality stocks, and I continue to be optimistic on the right stocks in 2022. And the other thing, too, that is out there is the cash amount in the economy. I mean, gosh, I look at the M1 M2 amounts, and what that is the liquidity of the economy. M2 includes your savings accounts, your checking accounts, your money market accounts. Well, right now it stands at $21.2 trillion. Say right now, that was the last reported amount, and that was from October 2021. But gosh, $21.2 trillion in liquidity. The reason I think that that's so important is it creates this floor, I believe, on the stock market. As you get that, let's call it a 10% correction, well, you still have $21.2 trillion in cash that can flood that market to kind of create that floor. Because you see a lot of people buying opportunity. It seems like the buying opportunities come when things go down 4 or 5% even. So if we did get some type of correction, I think it would easily revert back to where we're at just because of all that cash. And to kind of give you an example of how far we've kind of gone in terms of monetary policy and creating this liquidity, before the pandemic in January 2020, there was just $15.4 trillion in M2. And again, the M2 is your checking and savings accounts. So we're up about 38%. That is just so much cash in the economy, which could, again, create that question of inflation. And I know the Fed has now dropped that term transitory, but I do believe it is here to stay, which, again, all plays into the interest rates, the stock market, and inflation being a potential problem for the months to come and even the years to come as well. Now, talking about the real estate market, cover the bond market, the stock market, let's talk a little bit about the real estate market as well. And many are concerned about the rising real estate market. But there's a couple of concerns that I do have as well. And that would be population growth over the decade from 2010 to 2020 was just 7.4%. And now for the decade of 2020 to 2030, growth is expected to only be 4%. Now, the crazy thing is, the growth from 2010 to 2020 was the second lowest percentage gain in history. And I believe a lot of this is just stemming from people having, children later. It seems like a lot more people are have that career mindset, which is great. But it is hindering that population growth. The reason that impacts the real estate market, of course, is, well, it creates less demand for housing. So down the road, there's less demand. Housing market is still a supply of function demand. That could be problematic for the real estate market, of course, in the longer term. The other thing to point out is the mortgage payment divided by the after-tax household income ratio has climbed back to 30% after a low in 2012 of 20%. And this is a big problem, as it's the housing affordability, essentially. What you're paying out for that mortgage. You can't afford to pay out 50% of your income into that mortgage, so you got to keep an eye on that ratio. Now, I'll point out, it did hit a high in 2007 of 35%. So it could climb, again, above that 30%. And we did see, kind of looking at a long-term chart here. Unfortunately, you can't see the chart I'm looking at, but I'll tell you, back in like 2000 through 2005, the mortgage payment divided by the after-tax household income ratio hovered around that 30% level, and then it had that drastic spike during the housing boom in 2006, 2007, again to that 35% level. So we could see it revert back to that. But the problem I'm going to point out here is the rising interest rates. As I said, I'm a big believer in rising interest rates here. Your 30-year mortgage, I'm going to call it around 3% right now, could go back up to 4.5% potentially over the next few years. That is going to drive up the cost of the mortgage. Now, to give you some numbers on that, I mean, let's just use $1 million house as an example to make numbers easy, and especially here in San Diego, it seems like the only thing to do is buy $1 million house. There's not many opportunities for anything less than that level. So just use $1 million house just for informational purposes here. Let's assume you use a 20% down payment. So that means you have to come up with $200,000 here. You take out an $800,000 loan. Now, again, assuming a 30% fixed mortgage at 3%, let's say, your monthly payment would be $3,656.17. Now let's assume that same mortgage payment at 4%. Now that monthly payment jumps to $4,102.66. So that's a difference of $446.49 per month, or $5,357.88 per year. That is going to have a huge impact on the ratio for the mortgage payment to the income ratio. That could cause us to see that drive higher, which would, in my opinion, limit the opportunity for housing prices to increase. What I did as well is I looked at saying, okay, what if the housing market goes up 10%? Well, now to get that same house and keep the payment the same, you would either have to come up $100,000 or you keep that $200,000 down payment, and now you would have to take on PMI. So for 15 months, your payment at 4% would be $4,955.07. And even after that PMI, you're looking at $4,580.07. So you're talking about, we'll call it $1,000 difference between when interest rates were 3% and the housing market was 10% less. So the whole point here is you got to be careful, because with rising interest rates, the housing market can't climb like it's climbed over last year. If we were to see another 17% increase, let's call it, in housing prices, we just would not be able to afford it. People could not afford new homes. So this is one thing I am keeping an eye on. I don't think, again, we're going to see a major crash in the real estate market. Going back to that M2 level, there's so much cash out there that if we had, even I'll call it a 5%, 10% pullback in the housing market, I don't think we're going to have a 20%, 30% collapse just because of the liquidity out there. But I don't see the housing market appreciating much over the next decade due to the affordability and the likelihood of rising interest rates. So something to keep your eye on for sure, especially if you are looking at buying a home. I'd say be patient, and you might get concerned over, interest rates are going up. You want to make sure you don't overpay for the house as well. So there are multiple factors that need to be taken into consideration when buying that house. Last thing I want to talk about here before going out to the calls, I do see Jim and Alpine waiting patiently, but I do want to talk about Chinese investments and investing in China. I mean, you always hear, and it's really been in the news lately with some of the big names, but I can definitely see the allure of investing in China. Talk about the population size, rising incomes, very appealing. There's so many people in China, and the opportunity, as I said, for the rising incomes and the rising middle class, that is where I think the opportunity ensues that people get excited about. And there was recent data from McKinsey & Company that estimated by 2030, there could be 400 million households in China with upper middle and higher incomes. This would equate to approximately the same amount as the U.S. and Europe combined. So a lot of potential for money there. Other thing is, looking at millionaires alone, it is estimated that China could double to around 10 million by 2025. And gosh, looking at the billionaires, China has now amassed 1,058 people that were living there last year that had that billionaire status, which compares to 696 in the U.S. Now, big positives I point out here. And with all that said, I still cannot stomach the idea of investing directly in China. I mean, we've seen the nightmare stories, which include the fraud with Luckin Coffee, where that stock was, it's going to be the next Starbucks. It's so fantastic. Well, their numbers were fraudulent. Stock collapsed. People lost tons of money on Luckin Coffee. Now, too, we talk about Didi. Didi was the Uber of China. You know, it's taken over. There's such a big opportunity there. Listed on the New York Stock Exchange. Well, China wasn't very happy with Didi and the way they approached it. Now, all of a sudden, they're delisting from the New York Stock Exchange, and we've seen that stock fall about 50%. And I got to say, I believe the government has too much power there, which makes it hard for the private companies to prosper. The government has to like you in China for you to do well. That's too much risk for me to take on personally. I'd rather get exposure through U.S. companies that have sales in China. That way I still know there's a risk the company could be removed from the country or they could have issues with the government, but at least I still own a company with numbers I can trust and has sales in other countries as well. So a lot of people talk about the big names. I'm going to call it Alibaba. Well, look at the 52-week high here, $274.29 for the company. Now it's trading around $120 a share. I brought up Didi. The 52-week high for that mobility company, $18.01. Now its current price, $6.30. NIO, the electric car manufacturer that's going to take on Tesla, and it's going to be the next big thing. 52-week high, $66.99. The current level, $30 a share. Baidu, I'll call it the Google of China, the search engine, $354.82, 52-week high, current price $140. You might be saying, buying opportunity. I would avoid these companies. As I said, we now know Didi is delisting from the New York Stock Exchange. I would not be surprised to see some of these other Chinese companies as well delisting from the stock exchange. And a big reason for that is you've actually seen the SEC and the U.S. government here get a little bit more stringent on these Chinese companies. And the Securities and Exchange Commission did actually adopt amendments to finalize rules to implement the Holding Foreign Companies Accountable Act, also known as the HFCAA. And this law was passed last year after Chinese regulators repeatedly denied requests from the Public Company Accounting Oversight Board, which was created in 2002 to oversee the audits of public companies. And that's to inspect the audits of Chinese firms that list and trade in the United States. And the whole idea here is the SEC's job is to protect the U.S. investors. Well, if they can't get into the books for these Chinese companies and really be able to audit those numbers, how safe are they? So I do agree with the SEC and the government in this case of stepping in and trying to get a closer look. But with that said, I don't think China is going to be too fond of that plan, which is going to cause problems for these Chinese listed stocks in the United States. I wouldn't be surprised to see them just list in Hong Kong over time as they want to avoid the conflict with the United States and kind of keep all that data private. And the other thing, too, with China is I don't see our relations, unfortunately, improving. I mean, we have had issues, and President Xi there wants to be the world superpower. And we have to be careful by letting that country get too much power. I think we do need to kind of stand our ground here, and you got to be able to audit those books. That's an important thing to protect U.S. investors, and that's one reason we always say at our firm, we'll only invest in U.S. companies because we understand GAAP accounting. I still don't feel comfortable with what's going on over there in China to invest in one of those Chinese companies. So be careful with them. You might think they're a buying opportunity with the huge declines you've seen, but you could get yourself in a world of hurt if they do start to delist. It makes the whole investing process much, much more complicated. So with that, I do want to start going out to the calls. You want to join the show here, 833-288-0973. Again, that's 833-288-0973. And with that, let's go out to Alpine and speak with Jim. Good morning, Jim. You're on the Smart Investing Show with Chase Wilsey here. How can we help you?
Hey, when the cat's away, the mice will play, Chase.
Exactly. The show goes on, as they say.
Yeah, well, that's true. And frankly, I always very much appreciate your narratives on the stocks. I know you guys go over the numbers and everything, but your subjective comments, and actually I call them objective and subjective comments, are very valuable to me. So I appreciate that a lot. And speaking of China, how much? I mean, I thought.
Did we get a little feedback there?
Hello? Testing?
Yeah.
Can you hear me?
Yeah, I can hear you now. There's a little feedback from it, but I was hearing you say you appreciate the narratives on the stock, so not a problem there on giving the narrative. So continue on with what you were saying. I apologize for the feedback there, Jim.
Oh, that's all right. Anyway, I was saying I appreciate your narratives, your subjective comments, although they're probably objective and subjective numbers. But I really appreciate your feeling for the whole situation.
Of course.
Talk about China, and I seem to recall that they buy an awful lot of our treasury notes. And, we're talking about the Taiwan issue and all that stuff, but I'm going, well, how much of China is in the United States in the form, how much do they buy of the treasury notes, and how much do these foreign, we'll use the term adversaries, buy of our notes that we could freeze if life got tough?
Yeah, and I know this used to be a huge issue, and I know we want to talk about something else too, but the China issue, the notes used to be much, much more problematic. I don't have the numbers in front of me, but we did a discussion on this several months ago, and the Chinese amount of our notes has really declined over time, and probably a portion of that has come from the amount of notes that we've issued. But the positive,
Sure.
As a percentage basis, China controls a lot less of the notes that they did several years ago. So it's still somewhat of a concern, but not nearly as big of a concern as it used to be. And we always say, too, if China dumped all those notes, let's say, they would take a huge hit on their notes because you would flood the economy, the price of the bonds would collapse. Be a big issue for them as well. So I don't foresee that, but as I said, don't have the exact numbers on the China bonds at this time.
Yeah, I was looking at more of a strategic advantage, like freezing foreign accounts if things got a little strange.
Yeah.
What it would cost them to get crazy with us, so to speak. Anyway, let's get on to SO. I used to own it. I'm looking at getting it again. It's We talked about PPL last week. You gave me a lot of stuff to think about, and I remembered SO. And let's go over that if you don't mind.
Yeah, not a problem. So, again, the company here that we're going to talk about is the Southern Company. Ticker symbol is SO. It is a utility company. It looks like regulated electric. Not surprised here. Not much short percentage of float at just 1%. I don't think oftentimes people short utility companies because there's not as big as an opportunity. They're a little bit more stable than some of, let's say, your high-flying tech companies.
It's got a beta of 0.5, you know?
What was that?
It's got a beta of 0.5.
Yeah. So it does move around. A lot of times people obviously don't want to short them because there's not that opportunity here. Looking at institutional ownership, though, just 60.5%. Turning to the valuations, always very important that we look at what we're paying for the earnings of a company. That's 23.9 for Southern, is better than the industry average of 24.3. Well, price to sales, 3.2, higher than the industry average of 2.4. Price to tangible book value at 3.1, that is better than the industry average of 12.3. And price to cash flow at 10.9, slightly higher than the industry at 10.4, but not anything astronomically different there. Looking at the growth here, earnings per share over the last 1 year, they have declined 6% when the industry was up 13.7%. And over the last 5 years, earnings have climbed on average by 1.1% per year for Southern. Surprise here, sales up 11.4% for Southern over the last year, which is better than the industry, which declined 1%. I say surprised because sales up 11%, earnings down 6%. What happened there? I'm not sure if perhaps fossil fuels had some issues with the payments for the electric grid and so forth that caused the cost for the companies to rise, which could mean they could be raising their prices next year to offset those costs, but would want to understand why, again, sales rose and earnings declined. Over the last 5 years, those sales have climbed on average 4.2% per year, again, over the last 5 years. Looking forward, EPS growth for the next 5 years, estimated to be 6.5%. That is a positive to get that growth there for the company. It does also show a nice peg forward ratio of 3.5, which is reasonable for the business. Looking at the dividend, I know you like your dividends there, Jim. Get a yield of 4%, so a nice yield on the company, but a little disappointed here is the payout ratio is 91.9%. That is a very elevated amount there. And I know a lot of times the utilities, they will pay out more on that payout ratio, but still 92%, that's quite high. Turning to the balance sheet.
Is there anything, is there, like REITs have a 90% mandatory payout ratio. Is there any sort of mandatory stuff with utilities that you know of?
There's nothing mandatory with the utilities. I do know that, it's not a tech company that's going to have as much in, let's call it, research and development. So generally they don't have as much of that going out. One thing that I would be, I guess, a little bit surprised about, and especially with a company like we saw with PG&E, with, you got to keep those utilities up to date, so forth. I think the CapEx would be quite high for this industry. I haven't owned a utility in years, so I haven't really spent as much time looking at the capital expenditures that are required for the business, but 92% just seems high. I feel like they need to keep their business up to date, and it might be too much going towards that dividend and not making sure the business is growing and making sure the factories and the plants are staying with the highest technology that they can. So that is concerning. As I said, I don't think there is a requirement for the amount of earnings they paid out. But looking at the balance sheet, current ratio here is 0.9, above the industry average 0.8. So liquidity's just fine for the business. I do know a lot of times utilities do have a little bit lower of a current ratio. Looking at the debt to equity, though, 190%, and utilities generally do have higher debt. Industry is a higher debt industry than your other industries. Industry average, so 150%, so 190% higher than I'd like to see it. Don't like to see that. Looking at the days inventory, 67.7. That is above the industry average of 47.8. Like to see that lower. And day sales outstanding, that looks good at 29.7, below the industry average of 49.5. Turning to the net margin for this company, the profit margin, you see it's 13.4%. That's strong, as above the industry average of 9.5%. Return on equity, well, that's 10.3, above the industry at 7.2. And return on invested capital, also strong at 5.8. above the industry average of 5.5. Now turning to the current price for Southern, $66.84. It is near its 52-week high, $68.21. And the 52-week low, well, that's $56.69. You see a year-to-date return here of 13.4% for the business. As always, we want to go forward and see what we're paying for the future earnings of this business. I go out to 2022. I see estimated earnings per share is $3.53. Well, that would give us a target sell price of $58.60. So we do see it is pretty much, I'm going to call it, fairly valued here for the business. I'm still cautious on the utility sector. I think especially with rising interest rates, the sector generally struggles as they do have a lot of debt. They have to now refinance at higher levels. I know you get that nice 4% dividend, but I just don't see much in terms of stock appreciation. We talk about this a lot too with the utilities. Is for years, utilities didn't trade above, 15 times earnings, 2 times sales, and now I believe a lot of this stems from where interest rates are at. They've far exceeded those levels. So I'd be very, very cautious with the utilities. I know the allure is the income, but I just don't see much in terms of the capital appreciation in terms of the stock price.
Yeah. And your comment about interest rates, we haven't even started talking about the amount of the U.S. budget that goes towards paying the interest on those bonds. That's like 40% of the budget, as I recall. And when interest rates go up, that's what we need, is interest to be 50% of the budget.
Yeah. That's a great point. Yeah, I talked about the housing and how interest rates can impact that, but now the federal government, you go from 1.5 to 2.5. Now all of a sudden you're refinancing the U.S. government debt at a higher level and your interest payment goes up. So that's a great point there, Jim.
All right, pal. Well, listen, I always appreciate your thoughts, and thanks again for the extended review on SO this morning. And, have a great Christmas. And you guys are not doing next Saturday's show, I'm guessing.
Yeah, we're going to be taking next week off. I was going to save that announcement for the end of the show, but I'll probably repeat it. And last show, 2021. So, I guess what we'll say here, Jim, is we'll talk to you in 2022.
Yeah, okay. Well, I'm guessing you're taking the first off, too, so 2 weeks in a row, but that's just a guess.
we have an educational kind of show that we'll run on the first, yes, but we won't be here live, unfortunately.
Talk to you next year, pal. Thanks again.
All right, Jim. Not a problem. Great talking to you as always. All righty. Next up, let's see here. You want to join the show, 833-288-0973. Again, that's 833-288-0973. But next up, let's go out to San Diego and speak with Jairus. Haven't talked to Jairus in a while, so how we doing, Jairus, on the Smart Investing Show with Chase Wilsey here?
Oh, doing great, Chase. Before I forget, Happy New Year and Merry Christmas to both you and your dad. Looks like he's taking a day off today and the next couple. But doing really good. Keep listening to you guys every weekend, and I sure missed a 2-hour show. I'm not sure what happened there, but hopefully you guys get back to that. But anyways, I want you to take a look at Ally Financial.
All righty. Do you hold that, or do you hold that, or are you looking at buying it?
No, been looking at banks this week, and that's one of them that I thought, looking at some numbers, has some good potential. So want to see your feedback on that.
Yeah, and it is one that I kind of look at in terms of the financial sector. We talk about the rising interest rates. Generally, your financial companies can do well, especially if that yield curve can steepen a little bit as their net interest margin will actually improve. They are one of the sectors that can benefit from rising interest rates. Actually, we do our YouTube channel now, Smart Investing with Brent Chase Wilsey on YouTube. I took a look at Citigroup yesterday because I think there's just opportunity here with the financial company. So I'm glad you're calling in about Ally Financial. Again, that ticker symbol is ALLY. And before I get into the numbers, I forgot to say Merry Christmas and Happy New Year to you and your family as well there, Jairus.
Thank you so much. And before I forget, wife and I have been talking to her about you guys and sharing from your website. And in fact, I had her watch a little bit of the Citigroup yesterday.
Good.
And then also FT Foot Locker. She's warming up to you guys, so maybe we'll set up a meeting for early next year.
That sounds great. And we will return to workshops as well next year. So either way, we hope that we get to see you there.
Sounds great.
All right.
Thank you.
Well, perfect. So let's take a look at here the numbers for Ally Financial. Starting with the short percentage of float, I see it's 3%. Nothing to be too concerned about, but little bit higher than I anticipated. Wow, institutional ownership, 96.6%. Not much on the retail side, much heavier, again, on the institutional side. The valuations for this company, I just got to say, wow. Price to earnings multiple, 5.6, below the industry average of 19.3. Price to sales at 2.1, well below the industry average of 5.5. Price to book, well, that's 1.1, below the industry average of 4.6. And price to cash flow at 4.1 is below the industry average of 15.5. I do see this company is in credit services, so it's not like a money center bank. It's not. We talked about Citigroup a little bit. It's not like a Citigroup. It seems like it is in credit services where they focus their attention. Now, looking at the growth here, I do see earnings per share over the last 1 year. Well, that's up 299.5%, above the industry average, 74.1%. I do wonder, I pointed this out yesterday when I was looking at Citigroup, is we know these banks, these financial companies had a lot of loan loss reserves that they had to put on the books during the COVID crisis, I'll call it. So that hindered earnings a lot. Well, now as the economy has improved, those loan loss reserves have now come off the balance sheet, and they've been a big benefit to the earnings. I wonder if that's why you've seen a huge 1 year change there. But obviously a 300% change in earnings per share is not sustainable going forward. So we'd want to understand what happened with their earnings there, especially when you look at the sales over the last 1 year, just up 20.9%, but that is still better than the industry average of 11.5%. Looking at the last 5 years, though, sales have grown just 3.2% on average per year, trailing the industry average at 8.1%. And moving forward, earnings per share estimated to grow at 7.3%, well below the industry average 24.9%. So we want to understand where this company is getting its growth from, where those opportunities do lie. You do get a decent dividend yield here of 2.2% for the company. Payout ratio just 9.9%, though, so it tells me there's plenty of room to increase that dividend yield here. Looking at the balance sheet, again, as a financial company, so the earnings are a little bit different. Excuse me, not the earnings. The balance sheet's a little bit different. As you know, loans or assets, the accounting just looks a lot different for financial companies. I see a debt to equity, though, of 90%. Nothing to be concerned of for this business, but would want to take a closer look here. Looking at the margin, I do see it's 38.4%. That is a profitable financial company, especially I see the industry average is 28.8%. I see a good return on equity here, 17.9%, and return on invested capital of 16.2% also looks very, very strong. Now, looking at the current price, $46.24. It has fallen from the 52-week high of $56.61, which was hit in June of this year. And the 52-week low, well, that was $33.40, and that did occur a year ago on December 21st. So we have seen I'll call it an upward trend in the stock. As a year-to-date return, well, that's up 32.1%. And I'm not too familiar with Ally, but it is a decent-sized company at a $16 billion market cap. Do you use Ally Financial for anything there, Jairus?
I do use it, I believe, for like a online savings account for some cash, but that's about it.
Okay. Yeah, because I think I've seen them advertise they have a little bit higher, savings rates, and now higher is still not that high.
Oh, yeah.
But
yeah, like 0.2 more than everybody else.
Yeah, exactly. So instead of getting, the 0.1%, maybe you get the 0.4.5%, but, still.
Exactly. That's what I meant by higher.
Yeah. But let's see, looking at the earnings going forward for Ally, I do see next year, 2022, estimated earnings per share of $7.25. Gives us a very attractive target sell price here of $120.35. Now, as I said, the earnings spiked this year. This year, they're estimating $8.55. So that next year's level of $7.25 is substantially lower, but I do, again, wonder if that has to do with the loan loss reserves. But if not, I'd need to know why are the earnings falling so drastically. Was that $1.30 per share? That's a pretty huge decline.
Okay, I understand. Have to look a little deeper then.
Yeah, and on the surface, I think you have a very interesting company here. I think there's some great potential, but as always, definitely need a little bit more research here.
Okay, appreciate that. And before I go, Chase, I know you probably won't mention it because you don't do it too often, but I'm looking at some numbers and for my charity donations for the year.
Yes.
And like last year, sent over some money for Fighters Fight Foundation, and definitely going to send some over this year, just crunching the numbers, seeing what I can do this year, and really appreciate what you do there.
Well, thank you, Jairus. Yeah, it's really helpful, and since you brought it up, I'll let you know right now we're doing 5 Christmases for women with breast cancer. 3 of them are single moms, so it really goes directly to the women. You know, nobody on my staff takes any salaries or anything like that. There's no overhead. We don't do any parties or anything for our staff members. It all goes towards the women. So we really do appreciate that, and every donation really helps us out and helps out the women we support. So thank you for calling, Jairus. I appreciate that, and I appreciate your kind words and kind donations for the Fighters Fight Foundation. We will have to talk to you in 2022, and look forward to talking to you then.
Excellent. God bless. Good night.
All right. Bye, Jairus. All righty. Again, you want to join the show here. It's 833-288-0973. Again, that's 833-288-0973. I do see we have Carl in Oceanside and John in Coronado, and Harrison, our financial planner, just called in as well. But I do want to take one more call before we go to Harrison. So let's go out to Oceanside and speak with Carl. I see he wants to talk about bonds here. So, Carl, you're on the Smart Investing Show with Chase Wilsey. How can I help you this morning?
By the way, I lost on that Chinese Lucan's coffee. I made and lost, but I lost more than I made. But my question is, I learned my lesson from the Chinese stockings.
Got to be careful with those Chinese stocks. Yes, sir.
Yeah. So anyway, I noticed the I bonds pay over 7% interest. Now, if inflation stays that way, or maybe go higher, the bonds should pay also a good interest rate.
Yes, and the I bonds, I haven't looked at these in quite some time. Are these Treasury bonds? Where did you find these I bonds?
I stands for inflation bonds.
Mm-hmm.
So I looked it up, and they pay from November till April 7.13%, and then it will reset again for another half year.
Interesting. Yeah, Carl, I got to say, you stumped me here. I haven't looked at the I bonds in too much detail. I pulled it up very briefly. I do see what you're talking about. The initial interest rate on new series I savings bonds is 7.12%. Says you can buy the I bonds at that rate through April 2022. To be honest, it sounds intriguing, but how are they paying a 7% interest rate when the 10-year note's at 1.4%? I'm not saying it's a bad investment. I'm not saying it's going to go bankrupt or anything or not pay you the interest rate, but definitely have to understand where they're getting that excess interest from, because it's a very high rate, and I don't know how long that duration is for. Maybe they only pay it for a short period of time and then it's extremely low, but interesting bond to take a look at here. A 7% interest rate sounds intriguing, but as I said, what's the viability of that bond?
Well, it is a government issue. So do we trust the government?
I don't know. That's a great question. On the 10-year notes, we do know it's backed by the full faith of the government, faith and credit of the government. On the I notes, as I said, I'm not super familiar with them, so I understand it's a government instrument, but I don't know enough details on where they're coming from and again, how long they're paying that out for. So there's definitely a lot more to look into. What I might do here is I might pull it up and maybe have you call back here in a couple weeks so I can take a closer look at it and we can have a better discussion beginning of 2022.
Yes, okay, thank you.
Does that sound good? All right, Carl, well that sounds great then. So what we'll do is we'll table that conversation for 2022. I appreciate you calling in, and look forward to talking to you next year.
Yes, thank you, bye.
All right, have a good day, Carl. All righty, that does open another phone line. line. Again, phone number here is 833-288-0973. And again, I do see John Coronado. Thank you for waiting patiently. But I do want to go to our financial planner, Harrison, real quick here before we go to, again, John and Phil in San Marcos as well. So with that, Harrison, we got you there?
Yes, Chase, how you doing?
Doing well. You know, a little lonely in the studio without Brent, but we're managing.
So hopefully Carl's still listening, so I can talk a little bit real quickly about those Series I bonds. That wasn't what I was going to talk about today, but so the way that works is it's 7.12%. That lasts for the first 6 months of the term of that bond. Those bonds are, the total maturity is 30 years, but you can surrender them before that. But you're limited to buying $10,000 worth of bonds per person per year, and they're being offered right now, and as you said, until April of next year. So really, the most one person can buy is $10,000 right now before the end of the year, and then another $10,000 in January. So when you look at it, 6 months worth of interest at 7.12%. So really, on that $10,000, you're really getting a return of like 3.5%, because after that 6 months, it goes back down. So basically, to maximize the benefit per person, you could buy 10 grand now, another 10 grand again in January, redeem them after 12 months, because you have to wait at least 12 months in order to redeem them. And then by doing this, you get a total interest of about $712. So that's kind of what it looks like in a nutshell. So it's not like you can put a huge sum of money in there and make a lot of interest. The most interest you could get is $712 in about 12 months time.
And when you say it drops back down after 6 months, does it go to what rate? Like the Fed funds rate or something?
Yeah, essentially nothing. So
all right.
So
Well,
I've had some people ask about that, and it's kind of interesting. Yeah, 7.12% is high, but it's only temporary, and then it drops back down. And technically what happens is these bonds can be redeemed anytime between 12 months and to after that. But if you redeem them before that, at 12 months, essentially, the last 3 months of interest is forfeit, which in that case, that would be a low rate anyway, because it'd be months 9, 10, or 10, 11, and 12, which is low interest anyway. But in my opinion, not a ton of interest that you can get relative to how much you'd have to put in there.
Yeah, I figured. I mean, it kind of sounds like an annuity when they offer, the huge bonuses up front. But yeah, your money's tied away. It sounds kind of similar. You get a 7.12% interest rate. Wow, that's so great. But yeah, no, I'm glad you were able to look into it, because I hadn't really looked at them in too much detail, and yeah, sounds too good to be true. It probably is.
I've had some people ask about them, so I've looked into them a little bit. But anyways, so last live show of the year, I had a couple things I want to talk about. I'll let you tell me when you want to go to John and Coronado, Chase. But one thing I think I want to point out, this is a time of the year where a lot of people are looking at tax stuff. And one thing that you might want to consider, I did this with a client recently, is if you're looking back at the year and your income was higher than what you were expecting it to be, which means you might be in a higher bracket than you thought you were going to be, meaning you're paying more in taxes, one thing you can look at is if you are using an IRA as an income source. When people are in retirement, sometimes they have like a monthly draw from an IRA. All of that's taxable. Well, one thing you can do, if you're doing that and your income's too high, then you can take your last distribution from your IRA and put it back into the IRA, and therefore it won't be taxable. Technically, it's an indirect rollover. I've talked about it a little bit in the past, but this is something that might be appropriate to do here at the end of the year if you're trying to reduce your overall AGI and taxable income.
Yeah, and yeah, I remember talking to you about that a little bit yesterday, but it is something that I think people just don't really think about, and the big thing that it does is it I'm going to say manipulates your income a little bit to help save on taxes, right?
That's really what it is. So, if anything helps, especially if you're close to whatever that bracket looks like, if your taxable income goes a little bit higher than you want it to, you have some little flexibility. Another thing, maybe your long-term, short-term gain situation didn't work out the way you were looking at. Most people know short-term capital gains have a higher tax rate than long-term capital gains. But what some people don't know is that you can use short-term losses or long-term losses to offset short-term gains. So the way that kind of works is at the end of the year, you look at all of your short-term gains and losses, those will be net out, and then you look at all your long-term gains and losses, those will be net out, and then those two nets offset each other. So if you look back at the year and you've got a short-term capital gain and no short-term losses to offset it, you can look to see if there's any unrealized long-term losses that you can actually use to offset the short-term losses and then save a lot in taxes because that loss will then all be ordinary income rate deduction.
And what you're talking there, I think it's so important with financial planning is it really, you can have that plan at the beginning of the year. But as you kind of said, you sold something. I talked to some people. Yeah, I wasn't planning on selling my house, and I sold my house in the middle of the year, and you have this huge kind of tax event. You can have a great plan at the beginning of the year, but it's so dynamic where it comes November, December, now you kind of know what's happened in the year, and you have to be able to, kind of act quickly to make sure you take advantage of these different opportunities, right?
That's exactly right. We can't make every decision right now, and everyone's lives are dynamic, and the world around us is dynamic. So we need to continually be doing the right things to always be moving in the right direction.
Yeah, and I think that's the big thing that people miss with financial planning is they think they'll make a plan today, and in 10 years from now, I think they think it'll be right. And I think there's so much more that goes into it.
There really is, and I think there's probably a lot of advisors out there that do the same thing. Okay, we'll do this plan, and then I really just want to sell you this stuff, or I really just want to manage your assets or whatever. But the plan itself needs to always be evolving and always be changing as well.
Yeah, and I know you gave kind of two tips there, but any other good tips that people can kind of take advantage of before the December 31st, I'll call it deadline, but end of the year?
Well, another thing to look at if your taxable income is a little bit higher, we've got probably one, maybe two paychecks between now and December 31st. You might want to consider increasing your 401k contribution. That will give you a little bit more of a deduction to help offset your income there. It might make sense to do some Roth conversions. Roth conversions have a December 31st deadline, but I'll also watch out for how much Social Security you have and what type of long-term capital gain and dividends you have, because even if that conversion is at like the 12% tax rate, for example, that could result in you having to pay more taxes on your Social Security income, and it could push long-term capital gains and dividends up into the 15% bracket as opposed to the 0% bracket. So now that 12% tax on the conversion really became 30-something% because of the Social Security and dividend taxes. So, got to watch out for how the whole thing kind of fits together.
Interesting. Well, one other thing, too, I want to bring up was Jairus talked about donating to charity, and I know there is a amount that is I believe it's above the line deduction. What are those amounts again?
Yeah, so this is actually different than last year. So
Okay.
Last year in 2020 with COVID, a tax return, so whether you file single or joint, per return you could make a cash donation of up to $300 whether or not you itemize. Now that has to be done before the end of the year. This year that has changed, so now it's would I say $300? $300 per return was last year. This year it's $300 per person. So if you file jointly, you and your partner that you file with can each make a cash donation of up to $300 for a total of $600 and get that full deduction. That's on the federal side. And again, most charitable donations go on your Schedule A, so you have to itemize in order to actually get the tax benefit. But this is something new where you can still claim the standard deduction like most people are now, and you can still donate to charity up to $600 per couple and get a full tax deduction there.
Oh, perfect. Well, I do want to let you go. I know I got a couple callers here, so I want to make sure we get to them before the end of the show. So, as always, Harrison, I appreciate your wisdom when it comes to the financial planning side.
Thanks, Chase, and hello, John. I know you're next in Coronado, so I'll talk to you later, John.
All right, Harrison. Well, thanks for joining us. And again, that's Harrison Johnson, our financial planner. And if you're looking for something that really kind of you can put your arms around, there's a lot of different financial planning tools that you might be missing to help save on taxes, the estate planning. There's so much, the cash flow analysis, the Social Security that Harrison really focuses on, and that's all he does, the financial planning. He's on a salary, so he sells no products. He just does the financial planning side of the business, and he's done a great job. Many of our clients are very, very happy with what Harrison has provided. So you want to make an appointment with Harrison, you can call the office at 858-546-4306. Again, that's 858-546-4306, or go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. And I want to give one more plug real quick for my charity. If you are looking at charitable donations, don't know where to put them, check out my charity, FightersFightFoundation.com. Again, that's FightersFightFoundation.com, and it is a charity for women suffering from breast cancer. With that, let's go out to Coronado and let's speak with John. I appreciate you holding there, John. I know you've been holding for quite some time. So welcome to the Smart Investing Show. How can we help you this morning?
Right, Chase. Tell you what, the stock I'm looking at is Ford Motor Company.
All righty. And do you hold this one, John?
You know, it's one I don't hold.
Really?
But I'm kind of looking at it.
Okay. Yeah, I thought this might fit the bill for. I know you've talked about Caterpillar and other stocks like that in the past. I thought you might be a Ford guy here.
Well, I was years ago, and then the stock was just kind of stuck around $7. Sold out of that position, but it's kind of moved back up to 20, around 19 now.
Yeah.
I'm kind of wondering if it still has legs to go a little bit higher.
All right, and I got to ask you, do you own a Ford?
I don't.
Okay. No worries there, not a problem.
Though.
Okay.
I have, though.
You can still buy the stock and not buy a Ford. That's okay.
Yeah.
But with that, let's take a look at here the numbers for Ford. Obviously, we know it's an auto manufacturer, one of the biggest ones here in the United States. Short percentage of float, not very high at 1.9%. Decent amount of retail investors in the company's institutional ownership is just 53.9%. Looking at the price to earnings, quite surprised by this, 28.3%. Above the industry average, 19.7. I'm going to assume there was some write-offs or something that did occur with Ford. I have not seen them trade at 28 times earnings in a long, long time. So I'm guessing this has something to do with accounting, especially when you look at the price to sales at 0.6, which is below the industry average of 1.1. I mean, you're not paying very much for the sales at all. Price to tangible book value, well, that's 2.2 below the industry average of 4.6, and price to cash flow at 4.7, also below the industry average of 9.3. Now, looking at the earnings per share over the last 1 year, nothing there. As I'm guessing they declined. Earnings per share over the last 5 years down 17.3%. Again, I'm going to assume here they had a major write-off that was, I'm going to call it a non-cash expense that occurred. I'm sure they had some issues with semiconductors and so forth as well, but we want to understand what that write-off was. Over the last 1 year, those sales were up 2.8%, less than the industry average of 13.4%, but glad to see they still grew. Over the next 5 years, earnings per share growth is estimated to be 77.7%. That's a huge, huge growth rate. Again, I'm assuming they're coming off of a write-down that will not be occurring in the future years. So to kind of get them back on track, they're going to have some huge earnings growth in the next couple of years on that level. Looking at the dividend, you get a 2% yield with Ford. Decent dividend there. I know they have reinstated it. GM has not reinstated that dividend yet, so Ford did beat them to that punch. And the payout ratio right now is 0%. I'm wondering if that has something to do, again, with the income statement at this time. Turning to the balance sheet, current ratio 1.2, good liquidity there. Debt to equity, though, 400%. Very high debt. Now, one thing I always talk about with the auto manufacturers is I generally don't get concerned about it. I want to know what's going on with the operational debt because they also have financing that, as I talked about with Ally Financial, can really skew the balance sheet. So I'd want to look at the operational debt for Ford to make sure they don't have too much debt there. They are one of the large auto manufacturers that actually made it through the financial crisis without filing bankruptcy, so kudos to them for that. Days inventory, though, 42.6 below the industry average of 226.5. I like to see that number. Very efficient. Day sales outstanding, though, 117.5 above the industry average, 47.2. I'd like to see them be able to collect on their sales a little bit quicker. Net margin, 2.1%, well below the industry average of 6.1%. Return on equity at 7.8, below that 15 number I like to see, and also 12.6 is the industry average. And return on investable capital at 5.7 is also below the industry average at 10.4. Important to point out that net margin, return on equity, and return on invested capital can all stem from that income statement problem if they did have that major write-down, and could easily be fixed if that write-down no longer occurs. Now looking at the current price for Ford, $19.77. Well, 52-week high is $21.49, and the low, $8.43. I mean, this stock has been on a tear, up 126% this year alone. So it's done tremendous. And I know they had some issues they had to overcome. I thought they were very far behind in terms of the EV and the AV race, but they've really, I think, turned things around. And I kind of knocked the Ford Mustang Mach-E in the beginning. Now I see them on the road. I think they're pretty cool, and they're also expanding production quite drastically. So I think they've really gotten on the right track in terms of those two areas. I don't know enough about their autonomous vehicle side, but from what I've kind of read, it seems like they're making some strides there as well. But as always, want to look forward and see what we're paying for those future earnings. Let's go out to December 2022. I see the estimated earnings per share is $1.98. That would give us a target sell price of $32.86. So still above that current level of $21.49. 1977, $21.49 is the 52-week high. So still some room for growth, I think, on Ford here, John. I'd want to understand more about their long-term growth trajectory and what they're looking at in terms of those two new spaces. But I think there could be some potential here.
Mm-hmm. All right. Yeah, no, I kind of looked at it. Also, they've got some elevated options premiums looking at a year on it too. So I always like to do buy rights on stocks like this.
Yeah.
So, yeah, looks interesting.
All right.
Okay.
All right. Well, yeah, the numbers look interesting on it as well. So I as I said, I think there's some potential, and especially if it kind of fits into what you're looking at as well. I think it could be a good one over the next 5-10 years.
Yeah, you bet.
All right.
Thanks, Jason.
All right, not a problem, John. Great talking to you as always.
Bye-bye.
All righty. Let's go out to Phil in San Marcos real quick. I think I can run through the numbers just real quickly for Phil here. Good morning, Phil. You're on the Smart Investing Show. How can I help you this morning?
Hey, Jace. I heard you guys talking about Jabil a little while ago. I heard the CFO, he sold some shares at 65. It dropped down to the 60s. I bought a very small piece, and I was curious on your take because they just released earnings. They were decent. I know that you mentioned a while back that Apple is a heavy percentage of their revenue. Mm-hmm. I was more curious in their transcripts, if you look through them, as far as diversifying their end markets and the vertical integration that they're doing operationally.
Yeah, well, unfortunately, we used to own Jabil and don't own it any longer, so I haven't read their transcripts in quite some time, so I'm not sure where they stand in terms of their end markets. I know in the past they always were trying to diversify because they knew that Apple was such a large supplier, or customer. I don't know if Apple's business continuing to climb has been a good thing for them, obviously, because their sales and earnings have gone up, but has it now made Apple even a larger customer for them because Apple's continued to climb their sales and earnings as well? So something that I'd have to look at in the transcripts that you kind of brought up, but I don't have that information. I do want to run through a couple quick numbers here, running short on time, but the valuations on Jabil always look quite strong. Price to earnings 13.4, industry average 20.2, price to sales 0.3 below the industry of 1.1. There's a closing bell, unfortunately, but I do see debt to equity is quite high for this company. I'd be careful. Phil, I'm sorry to cut you short. I do have to get running here. Do have to get through the disclosure. Thanks for calling, though. And thank you, everyone, for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you would like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Chase Wilsey, at 858-546-4306. Again, 858-546-4306. Please visit our website at smartinvesting2000.com. And for more daily educational information along with investment tips, go to our Facebook group, Smart Investing with Brent and Chase Wilsey. Thank you again for listening. I hope you all had a great 2021, and we'll talk to you in 2022.
And may I say